You're on the air.
Thank you, Amy. We can't see ourselves.
Thank God.
Thank you very much, Amy. We appreciate that. Good morning, and we'd like to call to order the Length of Service Awards Program, the LoSAP Committee, for Friday, December 3rd at 9:30 a.m. We are located in the Chesapeake Building in Leonardtown, Maryland. Present is myself, Dr. Rebecca Bridget, County Administrator, Commissioner Mike Hewitt, Jeanette Cudmore, CFO, Mary Ann Murray, our community member, Catherine Pratson, Human Resource Director, and thank you to Michelle Rance, our administrative recorder, and Jody Kwasny, our plan administrator, as well as Amy Carter, our video producer. So with that, we will look at roll call. Item 2A for the approval of today's agenda. If you take a minute to review, we'll entertain a motion to approve.
I'll make a motion to approve the agenda.
We have a motion to approve today's agenda. Is there a second?
I'll second.
We have a motion and a second. All those in favor?
Aye.
Any opposed? Motion carries. Thank you. And item 2B is approval of the meeting minutes for August 27th. If you take a minute to review, I'll entertain a motion to approve.
I'll make a motion to approve the minutes of August 27th, 2021.
We have a motion on the floor to approve the minutes. Is there a second?
I'll
Second.
second.
One was a second.
We have a motion and a second. Any discussion? Hearing none. All those in favor?
Aye.
Aye.
Any opposed? Motion carries. Thank you. And item 3 is a presentation from Marquette Associates. We begin with the third quarter investment performance report, and we'll turn it over to Pat Wing. Good morning.
Good morning, Dr. Bridget. Thank you. And good morning again, everyone. It's great to see you all. So the performance report will be the top book in the packet laid out. The second book is a set of discussion materials for our later agenda items. But you can please hop over that cover page in the hardcover and grab Exhibit 2 and flip that over, and you'll see the first page there says Market Environment. So Exhibit 1 is just an overview or an update on Marquette. Nothing too newsworthy there. So we'll start where we always do. We see the market environment, and then on page 9, where you see the U.S. economy up top. As you all well know, we like to start with maybe 5-6 minute overview of the economy and capital markets just to provide context for what's going on and context for how and why the LoSAP fund performed the way it did during the quarter. So we'll start with the economy. Obviously, as we all well know, things have changed somewhat over the past week given the new variant that appears to be in the U.S. now. So at a high level, obviously, the range of outcomes is certainly a little wider, certainly as recently as a week ago. But with that said, I'll talk more about that as we work through some of the economic discussion. But if I could draw your attention to the top right chart on page 9 again, where we're just showing at a high level U.S. real GDP or economic growth. Now, the bars in this chart are the quarterly economic growth numbers, where the orange line is the year-over-year number, and the striped bars to the right are estimates. But if I could draw your attention to the last two fully colored in bars, that's for Q2 and Q3 respectively, and you can see the pretty steep drop-off in growth there in Q3. So the economy still grew, but at a much slower rate. And we talk about the reason behind that in the top bullet point there, and namely, it was pretty straightforward that consumer spending, which grew at a rate at about 12% in Q2, only grew at a rate about 1.6% in Q3. And as you all, I'm sure, well know, the consumer is the driving force behind the U.S. economy, accounting for about 70% of overall U.S. economy. So the economy certainly goes as the consumer goes, and probably a myriad of factors playing a role there. And we talk about some of those in the second bullet point, but at the risk of stating the obvious, the economy is still undergoing those supply chain issues, inventory issues, and as consumers, you can't spend money on what's not available. right? So we've all gone to the grocery store recently, seeing the shortages in household products again. If anybody's in the market for a home durable good like a fridge, washer, couch, things of those nature, they're on back order for months and months. So the economy's still grappling with these issues, and you can see that it's illustrated in the bottom right chart here on page 9, where it's just a survey of U.S. manufacturers about their supplier delivery times. And when that line is higher, it means there are slower deliveries and vice versa. And if you look all the way to the right there, you can see we did see some marginal improvement earlier this year, but then those supplier delivery times worsened in Q3. So clearly these supply chain issues are still at the forefront, and that's really what's led to a lot of the inflation that we've seen over the past 5, 6, 7 months or so. It's largely been in goods prices, so think manufacturing, right? Used cars, commodities, food prices, things of that nature. Now when we think about things moving forward, and I'll take a step back quickly with the new variant, we have seen some new travel restrictions. They may be in the U.S. They're certainly abroad now. Not many lockdowns, excuse me, notably outside of emerging market economies. But again, given the complexity of the global supply chain, those supplier delivery times as we head into 2022 may even slow further and therefore exacerbate some of the inflation that we've seen already in goods prices. Now, as far as other parts of the economy are concerned, if you skip ahead to page 10 here, we talk a lot about the labor market. So if you look at that top chart to the right, what that's showing is a survey of small businesses across the U.S. They ask a myriad of questions, and one of them is here, what percentage of firms have one or more hard jobs to fill? And look all the way to the right there. We're at least a 50-year high. More than half of respondents say yes, we have one or more hard jobs to fill. So the supply of labor is just not there right now. And within that, the quality of labor, in other words, the prospective employees that employers are looking for, are just not matching up with the skill sets that they're looking for. So long-winded way of saying that the supply of labor has gone down, just like the goods that we've seen that I spoke about a second ago. So what happens? The price of labor goes up. And we've seen that in the same survey. Firms that had recently raised compensation was at a 42-year high. Firms planning to raise compensation in the next few months, a record high, which in isolation is a good thing, right? Consumers, higher wages, more money in their pockets, hopefully drive consumer spending, driving economic growth moving forward. But at the same time, from a capital markets perspective, if companies cannot pass along those increases to consumers, then it could eat into profit margins, eat into, the profits of corporations, and therefore have somewhat of a negative impact on equities. And I think we saw a little bit of that theme play out in the third quarter, which we'll look at here in just a second. But then also from a fixed income perspective, generally higher inflation leads to higher interest rates, which puts downward pressure on bond prices as well. So if that dynamic continues to unfold, and again, the variant has certainly introduced more uncertainty, I think as we head into next year, if inflation continues to rear its ugly head, we could certainly see a little bit more of a volatile environment, at least relative to what we've seen this year. Despite the last week notwithstanding, where we've seen some weakness, generally this year has been exceptionally strong. I mean, the biggest peak decline in the U.S. equity market we've seen is just about 5%, which is well below the historical average of about 10 to 12%. So if these dynamics continue to unfold as we head into next year, I think we could be looking at more of a volatile environment. And when we get to the recommendations, it certainly reflects that theory, on our end, that narrative. It's not a time to be taking huge bets right now, given the uncertainty within the fund. So when we get to the recommendations, that really bears out our thinking as it relates to that. Any questions about the economy before we look at asset class performance and move into the fund itself?
Tell me, I've been really, not that I'm really worried about inflation. I'm not really worried about anything. My point to you is this. With all this government stimulus spending that's going to, this Build Back Better bill, if and when it's ever passed, along with what's already been out there, and I was having a discussion yesterday with somebody about our county budget, and his point was there'll always be stimulus money. There'll always be money coming out of Washington, D.C., and there'll always be COVID. It's like we had the Afghan war for 20 years. This COVID's liable to just take the place of the Afghan war as far as having to, people have to buy PPEs and all this additional cost associated with trying to keep that pandemic under control. But the point is that we've heard that inflation will be transitory, i.e., maybe March or second quarter to third quarter of 22, that it will dip down below 2% or prior to where it was before the pandemic. Now, my thought, and again, it's just my thoughts, but I'm interested in yours, is that this inflation thing, what's going on with a lot of people, me included, is when I can't buy it and I do find it, if it's higher, I just buy it anyway, because at least I can get it. And there's this other idea that people have more money because they couldn't spend for so long. That's something else we've been hearing, that the savings is so high. So with all that said, what's your take on inflation long-term, say 12 months, 18 months?
So I think you're spot on as far as the rate of change, right? So the most recent CPI report, I think inflation rose year over year a little north of 6%, which was the highest number we saw since 1990, so over 30 years. As we head into next year, the dynamic is, all else equal, which it never is, but the rate of change is still going to be elevated, but it looks like it is going to decelerate to some degree. Now, is it going to decelerate to 2%? I think that's unlikely. I think it's going to be more elevated than that, and then longer term, even 12 to 18 months or even a little bit more of a more intermediate term, I think, the inflation that we've seen over the past 20 years, which has kind of been in this 1.5%, 2% range, we're probably looking more at, 2 to 3%. So,
okay, I guess what I'd say, I'm sorry to interrupt you.
No, sure.
But what goes through my mind is you're right about wages. Okay, we're trying to get people back. We're paying whatever it takes to get them. You're hearing restaurants paying $15, $16, $18, because they need the help. Now, I guess my thought process is if this supply chain thing ever figures itself out, we ever get enough truck drivers or whatever it takes to get the markets, the inventories built back up, are these people going to take wage cuts? And my answer to that is they probably won't. So it seems like we're building in a higher rate just based upon the wages, which are good because working people will have more money. But I still say this. I used to be a small business. People making $15, $16, $18, that's good, but it's still low wages. It's, it's the $30,000, $40,000, $50,000 a year. Mm-hmm. And when that market gets raised out of what was minimum wage, $11, $12 an hour, whatever it was, out of the $25,000 to $30,000 into the $40,000 to $50,000 range, it just seems like we're going to have high prices because labor is going to continue to be high.
Right. Well, that's a really good point. The other dynamic there is that, the lower income cohort tends to have a higher propensity to spend, right?
Yeah.
Because they can't save. So if those people in the lower cohort are making more money, then that's going to increase demand, essentially, right? And, we've learned from lower supply, and even we've had higher demand given all the stimulus. It's really been both of those factors driving inflation. So even if the supply chain does moderate or improve like we all well hope, if those rising wages do continue into the future, like we do expect right now, just given the dynamics in the economy and the labor market in particular, then that's going to really offset the improvement of the supply chain. So in that 12, 18, or even month or even longer period, we think sort of the steady state or equilibrium inflation rate, again, is going to be higher than what we've seen over the past, 15, 20 years. Right. So when we think about that from an economic perspective, spot on, as I mentioned, I think that's a positive. But again, us as trustees on the fund, we're really more concerned about with how does that impact the asset classes within the fund, and do we have protection within the fund if that environment does unfold with higher inflation through diversification, right, to have that downside protection. What are the
things to look at if we do have higher inflation? Because I do believe we will have higher interest rates. I mean, this free money, this low money has been for a long, long time, and we're getting used to it. It's been, I don't know how long it's been, but it's been a long time. And with that said, it just seems like, when we get off that diet, we're going to have higher, I just believe we're going to have higher inflation, higher costs.
Mm-hmm. Yeah, so one of the things, if you recall, and we'll talk more about this when we look at the investment policy statement later, compared to where we are right now, we have a, pretty much kind of like a 60-40 portfolio of equities and fixed income. So if we do have higher inflation, eventually we're going to be lowering that fixed income, not, to a great degree to, put on a lot of risk on the table, but inflation would impact fixed income negatively, right? But at the same time, within the rest of the portfolio, there will be additions. We'll keep some of the REIT allocation, which is generally does better than broad equities in that environment. The infrastructure allocation, which should play a similar role, and then a small allocation of Treasury inflation-protected securities too. So when we move in that direction, if that doesn't fold, we're going to have more protection within the fund to protect the rest of the assets if we do go into that environment.
Okay. We'll just banner on now. I'll let you continue.
Okay.
Good discussion. Thank you very much.
Absolutely. So if you skip ahead to page 12, please, now, we'll skip over 11, the global economy. The story is largely similar. Growth slowed and inflation was really ticking up. But talk a little bit about asset class performance, and I think these inflationary dynamics that we're speaking to will be borne out in some of this discussion. So if we focus on page 12, really the right-hand side, we'll start with those first three rows where you see the equity markets, U.S., international, developed, and emerging. And the green bars are the quarterly numbers. Sometimes you cannot see the green bars because those numbers are pretty flat. Like in U.S. equities, they were down ever so slightly. So taking a breather from the historic run we've seen since the end of Q1. And interestingly, that number masks a lot of the intra-quarter moves. Specifically, that July and August were actually quite positive, up about 4%, maybe close to 5%. But September saw a pretty big drawdown of about 4 to 5%. So it was an environment where the first 2 months were good, and the last month was actually quite poor and offset those gains. And why I mentioned that, why that's important. If you recall, there was a big contribution into the fund in July, and we talked about the rebalancing at our August meeting. So that contribution came in, and we rebalanced the fund across the board to take the asset classes to the respective weights. So then in July, equities were doing good. August, equities were doing good. So equities became overweight as we headed into August. So we had a little bit more money in equities relative to the targets. So then when September came down, that was a detractor from a relative perspective. So it's a long-winded way of saying, since we didn't meet for 3.5 months or so, we didn't necessarily have the opportunity to rebalance. Now, given next year, and we've talked about this, the importance of, increasing the frequency of the meetings, I think we're going to 2 months now. And since markets are moving so fast these days, that will mitigate that risk moving forward. We'll be meeting more frequently and having the opportunity to look at this and making proposals so we don't find ourselves in a similar situation. With that said, the last thing I wanted to mention are two other quick things. You can see underneath emerging market equities in the U.S. bonds there to the right, they were up ever so slightly during the quarter. So interest rates moved up just a tick in really intermediate term maturities, putting a little bit downward pressure on prices, but the quarterly income being paid from those bonds more than offset that, so they were slightly positive. But just to echo my comments from a second ago, if you look at those bottom three rows where you see TIPS, commodities, and U.S. REITs, those are, again, more inflation-sensitive type assets. So you can see TIPS were actually up just a shade under 2%, so well ahead of sort of those investment-grade bonds that were just up 0.1%. See commodities, they're really the best performing asset class, and then REITs again, just marginally ahead of the game compared to the broad market, but again, really driving that theme of those inflationary concerns drove some of the weakness in sort of traditional equities, but those asset classes that generally respond a little bit better to inflation, and two of which, TIPS and REITs, which are going to be a part of the portfolio moving forward, did better in an environment where inflation was an utmost of a concern for investors during the quarter. So with that said, let me pause there for any other questions or comments, and we'll jump into the fund itself as far as the data, returns, and market values.
The last concern, not the last, but another concern I have is, how do you guys feel about these? When I look at these emerging markets, I was reading this last night, and international, that's lagging behind, and I think it will. And I think what the common denominator there, these people are not getting vaccinated. What I thought was very interesting about the Omicron, that in South Africa, 24% of the people are vaccinated. So when you have these emerging markets that obviously are influenced by inflation and same things we are, but they're not vaccinated. That seems to put them at risk or have a higher risk of additional costs, whether it be for health care or additional cost to the world, to the wealthy countries to do something about that. What's your thinking?
So a couple different things. So it's always important to take a look at, what's happening right now from an economic perspective, and then taking a look at it from the equity market perspective, because even though they're somewhat related, over the long term, what happens from an economic perspective has little bearing on long-term returns for an equity market. So your point's well taken. Emerging markets were under pressure during the quarter for reasons I think you mentioned. The other big thing was in China, there was a big regulatory crackdown on some of the largest tech companies, and also some concerns around a large property developer there, whether or not they were going to default. So that put Chinese equities under pressure, which many other emerging market equities traded down in sympathy with that. And this year, if you look at the returns, the S&P, I think, is up 20%. International developed markets are up around 10-ish, but emerging is actually flat. So equity markets have had these huge gains where emerging hasn't necessarily participated. So the vaccine component definitely driving things. The other thing is the U.S. dollar's been pretty strong this year, which is generally an environment that's tough for emerging market equities. And lately, the U.S. dollar's been very strong because the Fed has sort of changed their policy approach, where now they're saying we're going to scale back our bond purchases, we're going to start raising rates, which has been favorable for the dollar. Now, next year, we're of the mind that the market has got a little bit ahead of itself, pricing in those Fed rate hikes, which have been very bullish for the U.S. dollar, and sort
So
of
we've already seen the effects?
Right, because markets are anticipating that, right? So if inflation does decelerate, or perhaps maybe even come down a little bit lower than expectations, then that gives the Fed room to kind of back off some of these rate hikes, which would therefore be bearish for the U.S. dollar and quite bullish for emerging market equities. And when you look at it from a valuation perspective, emerging markets have underperformed U.S. and international developed woefully over the past 7-10 years. So they're actually quite cheap right now relative to those markets. And like we talked about earlier this year, the biggest driver of performance moving forward is basically the price you pay for something. Right? If you can buy it cheap, usually returns are better, and vice versa. So even though the short-term dynamics are not favorable, if we think more of an intermediate-term time horizon, we do think emerging markets are going to be probably an outperformer. Now, we wouldn't be putting those chips there right now, or maybe even early next year, but I think in the latter half of next year, we might start to see that cycle turn in their favor, just given how cheap those markets are.
Thank you. Any other questions or comments from the board members? Questions for Pat? Okay.
All right, if you please hop behind Exhibit 3 now, we'll walk through the fund itself. So we'll start on page 19, some high-level observations, and we'll run through the data here in just a minute. But you can see at the top, again, on page 19 under observations, the fund ended September at about $9.3 million. And we'll have an update on the value of the fund here shortly in the recommendations. But that translated, there was an investment loss of $85,000 you see there, and it translated into a return of down 0.7% relative to that policy index of down 4%. And I talked about really the reason behind that was the equity overweight headed into September at a time equities trailed off after that. And there was one other key dynamic that I'll get to in just a second. But before getting there, you can see that second main bullet point, again, just reiterating that contribution was made in July, rebalancing shortly thereafter, which we shared with the committee. But if you look at the negative attribution, the last sort of main bullet point there, so again, this is, what explains the fund's performance relative to the benchmark. So is the equity overweight, and also what's called fair value pricing. And at the risk of getting too technical here, what that means is if you're, as a U.S.-based investor, have investments overseas or in funds that invest overseas but traded on U.S. exchanges, the benchmarks for those funds are priced in the local currency. So how those equities close on their local exchanges, which close for trading before the U.S. But then these funds that trade on U.S. markets will be adjusted in pricing depending on what happens in the U.S. So in other words, if you have an investment in, a foreign car company, right? But at the end of the month, you have the Toyotas and the Fords in our market selling off hard or declining, then the foreign car company that's priced on a U.S. exchange is revalued down despite what happened in the local currency, just because we're U.S. investors and that's how the mechanics work. So in the end of September, when markets declined, then those investments on U.S. exchanges declined further than the indices because of those pricing adjustments. And I'll show you that here in just a minute. But that was another key driver, since there's only index funds outside the U.S. They were revised downward in price relative to the benchmark, since U.S. markets declined notably in the last week of September. So with that said, if you look at page 20, just a quick rehash or high-level summary of the summary of cash flows here. So at that top table, you can see we began at about $6.2 million. The net cash flow, just a shade under $3.2 million. It's not exactly 3.2 because there were some fees coming out there towards the end of the quarter. And then the net investment change. So all told, the fund did grow by about $3.1 million. And the returns I'll get to again in just a second here when we look at it from a peer perspective. But the last thing I'll mention, if you look at the bottom of the page, the asset allocation versus the targets, you can see when you look at U.S., non-U.S. emerging market equities, when you sum those two compared to the policy, we ended up on target because we were ahead, we were over target, and then things declined, and then we ended up on target at the end of the quarter, given equity market weakness. So if you skip ahead to page 21 here, on the next page, excuse me, just a quick rehash on the bottom table of what took place during the quarter. Again, since we had the large inflow, you can see additions to all the various managers across the board there. Again, things were taken relatively to target. Now, they were done in equal dollar amounts. You can see, various investments there, not really, to the thousand, and that's because these are all ETFs, and they pay dividends during the quarter that are thrown into the cash part of the portfolio. So that's why if you added maybe it was $660,000 up top to the large cap Schwab ETF, at the end of the quarter, it threw off a dividend that then went into cash. But you can see, again, all those investments were made in early July, and again, everything was taken back to target at that time. So we skip ahead to page 23, if you will, talk a little bit about things from a peer perspective, and then I just want to highlight a couple other quick things before we move on. So on page 23, this is the peer universe page. We've talked about this before. We use a third-party platform to generate these reports. Many other public defined benefit funds use it. A lot of data, a lot of analysis on the page. The key takeaways are those bottom two rows in the bottom table where you see the circle and the triangle there to the left. So if you work your way from left to right there, you can see that negative 0.7% return that was below the median during the quarter. So 50 would be the median. Lower numbers would be below the median or better than the median, from a return perspective, and higher numbers below the median or lower returns relative to that median. If you look year to date, similar story, but a flip side for the fund relative to the index. So the fund's up 7.5%, still ahead of that return for the index at 7.2. And as you work your way from left to the right, the story's largely been the same as far as the return relative to the benchmark and relative to peers. And we've talked about this a lot during our asset allocation discussion, how this fund was really relatively conservative. I think as the county began to fund it from an asset allocation perspective, pretty conservative to other peers, and I'd argue rightfully so. So that really explains the rankings there on the short and intermediate term. But most importantly, markets have been strong, and those returns are above the assumed rate of return. So when you're making more money than the actuary is assuming, the funded status or the health of the fund grows over time.
Sure.
Mm-hmm.
So with that said, just another couple quick comments. If you look on page 26, I just want to illustrate the comment I made around fair value pricing a second ago, and then touch base on the fees. So on page 26, if you look at those darker rows, those are the asset class returns. So the top one's the total fund, like we talked about, and then the rest of the darker rows are the individual asset classes. So the second one there, the U.S. equity composite, if you work your way from left to right, was in line with the benchmark. It's what we would expect, right? All low-cost passive approach. But to illustrate my comments around the fair value pricing, if you go in the middle of the page where you see developed non-U.S. equity composite, again, that Schwab International ETF is a passive fund. But you can see it was about 1.5% behind the benchmark because of that pricing, right? So when the markets declined, the adjustment in the price of that investment goes down based on what U.S. markets do. Now, this washes out over time, and you can see it if you look all the way to the right for that Schwab International ETF, since it was in the portfolio about 3.5 years ago, it's more in line with the benchmark. So this quarter, it was a headwind, and then it kind of reverses course and washes out over time. But then you can see it's a similar story for the emerging markets below that, where the index was about 70 basis points behind the benchmark, again, because of that fair value pricing issue. But when you look all the way to the right, they're essentially in line with the benchmark over the 3+ year period. So quarter in, quarter out, it can have a good impact or have a material impact. But over time, the things wash out. And then, as you would expect, the indices are largely in line with the benchmarks. So with that said, unless there are any questions, I just wanted to comment on page 29 here to wrap up on the fees. So we made an adjustment to this page based on the board's request. So we're still showing the underlying investment fees up top here. So the bottom row where you see investment management fee in that top table all the way to the right, you can see the annual expense ratio, which again is low. Given the fund is small, we want to focus on being conservative, keeping the fees down, keeping dollars in the fund so they can grow over time. But per the board's request, across all funds, we've added our fee there. So you can see in the bottom table, the Marquette Associates fee, the estimated annual fee, and as a percentage of the fund itself. So again, just to reiterate, obviously we're working across 3 funds, and it's on a pro rata basis based on the size of the funds themselves. And you'll notice here there's no custody fee. So with Schwab, they're not actually charging you to hold the assets. You kind of get what you pay for on the client service side and some of the other aspects. But once we go through the custody transition process, which we'll update you on a little later in the meeting, and we have that fee, we'll then add that there as well. So just in the interest in transparency in the board's request, I wanted to point out that page as well. But with all that said, that pretty much wraps up my comments for the performance report. But again, happy to answer or address any questions.
I have a question, Pat.
Yes.
You made the comment that because we only meet every 3 months, that we weren't able to get ahead of the equity rebalancing.
Mm-hmm.
So what would we have done differently if we're meeting every 2 months? I guess that's what I'm...
Well, it really just gives us more frequent opportunity to meet. And as you know, we bring those fund allocations every month. So instead of meeting every 3 months, or sometimes the calendar worked out to every 4 months, even though we're meeting 4 times a year, we're pretty much being set on a 2-month schedule. So it gives us an opportunity for us to pull the values of the fund and then bring them to you all and make those recommendations to rebalance as appropriate. So had we been meeting every 2 months in theory, then we would have had the opportunity to say rebalance or maybe take some equities off the table and rebalance into fixed income, which we didn't have now, but should have moving forward if we meet every other month starting next year.
So with your other municipal clients, how often do they do rebalancing?
It depends. So when I say it depends how often they meet. But usually we'll always bring this information to the table, and it can always look different depending on what's going on in the markets. But based on where things fall relative to policy, the risk tolerance of the committee, the assumed rate of return, we have to take all those factors into our recommendation for rebalancing. So I would say those that meet on a quarterly basis, they're still usually looking at it and rebalancing on a quarterly basis. But those meeting every 2 months, which we have some, they're still doing the same thing, but it's helpful just from a diversification perspective as things zig and zag to take a look at it more frequently and then execute any rebalancing from a risk management perspective. So that'll be the big, positive addition, just being able to have these conversations on a more frequent basis.
Thank you.
You're welcome.
Yeah, I would agree with that, actually. And I think my perspective on this is just because we're meeting every 2 months don't mean we rebalance every 2 months.
Right.
But the bigger issue, in my opinion, would be that, the global, what's going on out there.
Right.
And, if something happens tomorrow, and we had to wait 3 months to like get a chance to talk about it, I mean, I'd hate to see a, excuse me, large market correction go on and have us say, well, we're going to wait 3 months before we can take a look at this.
Right.
But if something like that happened, we wouldn't even wait 2 months. We wouldn't even wait 2 months. We would try to do
Well, we
something.
could do something emergency or whatever.
Right,
Right,
emergency.
you could call a special meeting.
Right.
Right.
If we needed
Right,
to.
right.
Yeah, special meeting, that's better.
Yeah, but to Commissioner Hewitt's point, I mean, if you just think about it, the pandemic, right, markets topped mid-February, down 35%, and it wasn't even a full month before they started to rebound. So if you were only meeting in 3 months, we had a lot of clients that met in early mid-February and things were kind of okay. And then things sold off, so they were way underweight equities given the decline, and then weren't able to rebalance and capture a lot of the rebound just due to the nature of the meeting schedule. So
Well, I think it's the amount of, and I hate to use the term liberty, flexibility, that's a better term, that we give you to rebalance based upon events saying, hey, look, maybe a call to the extent of this is going on, you may want to move it. I don't even know if that's something we want to consider. But how much flexibility do we give them to rebalance? They can't rebalance unless they come here
That
with
was my
this.
question.
Right.
oh, I'm sorry.
No,
That
no,
was
no,
a
I'm just,
question.
now that you said it, that's exactly what I was wondering, like,
We don't have the authority to do it.
okay,
Right.
Okay. And we wouldn't want you to,
Right.
right.
because we want to keep an eye on this. Don't get me wrong, we can keep an eye on you. But I guess the key gets to be, is knowing when it's time for us to
Right.
make a decision to.
And I don't know if that's a question for right now or offline, just the mechanics around us getting in touch with the board and the committee to actually call a special meeting. But honestly, I don't even
Well, I
know
would
the
think
mechanics behind
You
that
would
as
have
well.
the liberty, I'm not speaking for everybody here, I'll speak for myself, to say, hey, look, guys, we should talk about this. Something to the county administrator to say, hey, look, this just happened, we should, get a conference call going or something.
Yeah.
Yeah, and I think I think there's two things that we're really describing. One is moving the meetings to every other month, so we have 6 instead of 4 to try and capture that on a more timely basis. And the other is not to act rashly.
Oh, sure,
So
absolutely.
we also don't
Absolutely.
want to be too quick to move, which is why I think some of the structure is put in place so that we do have the information on a 60-day basis that says this is what we know, and then the recommendations come in, so that if we need to have a special meeting in between, we certainly can, and that process usually comes through Catherine's office as the plan administrator, and then we poll the board for a special meeting, or the chair can call a special meeting because of that emergency, for example. So we do have that flexibility to do. We just want to be cautious not to overuse that, which I don't think we have, and to act in an emergency instead of a methodical way. That's my only thought.
Sure, that makes perfect sense.
We're on the same sheet of music.
Great. Any
Okay.
other comments or questions? Then we'll need a motion to accept the third quarter investment performance report.
I make a motion to accept the third quarter investment report per Marquette Associates.
Do we have a second?
I'll second.
We have a motion and a second. Is there any discussion? Hearing none, all those in favor?
Aye.
Any opposed? Motion carries. Thank you. And then, Pat, I think we are moving to recommendations and then to the investment policy statement, so.
Yes, thank you, Dr. Bridget. So these items are found in the other book that was in your packet. So starting with the
Russian materials?
Yes, sir.
Okay.
So starting with the recommendations, you'll find that if you grab Exhibit 1 and flip that over, you'll see this on page 4. So a couple of quick comments here. You can see in the third column from the left where you see total assets up top, we're at about a shade under $9.5 million now, so up about $200,000 since the third quarter, because October was quite strong. Markets were up about 5 or 6%. The weakness we've seen was in November, really in the last week in total, but, excuse me. Excuse me. So we're up about $200,000 from an allocation perspective. If you would all look at the bottom left table here, and we see the asset classes listed to the left, In black, their allocations, and in blue, their targets, and to the right, the differences where green is indicative of an overweight and red vice versa. So a couple things to draw out before we get into the specific recommendations. You can see U.S. equities are about a percentage point ahead of
Those are talking, so I got your big bottle.
international
Thank you, Commissioner
and
Hewitt.
emerging markets. Thank you, Sarah.
Anybody else want?
No, thank you.
So you'll see there the big overweight to emerging market equities, U.S. equities, and the other key underweight, third up from the bottom there, fixed income, and then all the way at the bottom, cash. So like we talk about frequently, when we have the recommendations, we usually have decent amount of cash because, again, those ETFs are throwing dividends into cash throughout the quarter. So in light of my comments earlier around the sort of range of uncertainties right now, we don't think it's a time to be taking, wide bets, if you will, right? We think rebalancing discipline is important as things stand today. So you can see this illustrated in the middle column of the top page where you see rebalancing. So right now, since we're a little overweight U.S. equities, we're recommending a $40,000 redemption from the Vanguard S&P Mid-Cap 400 ETF. That would go into the iShares Core U.S. Aggregate Bond ETF further down that page. Obviously, you see that number's 80,000. So the other 40 would come from existing cash. So we're drawing the cash down to about 20 grand. But a lot of those ETFs, the equity ones, they pay dividends in the third month of the quarter, later this quarter. So as soon as we draw that down, it's going to build right back up before
Cash will
year
come
end.
back.
Exactly.
Why are you taking out a mid-cap versus large cap?
Versus large cap. So when we think about the breakdown of the market itself, large caps, since they've outperformed so drastically over the past years, are about 75 to 80% of the total market. So when we look at these proportional numbers here relative to each other, relative to that 30% target, we're kind of in line right now with the market. But again, since we're headed, or we believe, again, the uncertainty is a little higher, if we do experience sort of this volatile environment, history tells us that those larger companies, higher quality, safer companies would likely outperform on the downside.
Okay, so you think you get a better return on the big guys?
A better relative return,
Yeah,
right?
I get it, yeah.
Yes, sir.
My thought process when I looked at this last night was that the larger number will give you more, what's the term? Flexibility, less movement. I mean, to take 40,000 of the 2.4 million versus 325,000, it just seems like you're taking a smaller percentage of the big number.
Right. But then, it's always how
But the big number's making more money. I'm with you.
Yeah, exactly.
I got it.
Exactly. And then as you can see the impact there to the bottom chart, the bottom chart to the right, basically we still have an overweight to U.S. equities, but when you sum the equity components across the board, it's basically flat. And then the fixed income investment grade would be then, up closer to zero, and that cash would be drawn down. So again, not a ton of bets within here given the uncertain outlook. And then those recommendations are therefore summarized then on page 5.
All right, back up again. I still have one on
Yes,
4.
sir.
Sorry. I was thinking about this last night. So you want to go into aggregate bonds with this for 80,000. And the idea don't you think the bond market's going to get weathered with the interest rate increase?
So from a relative perspective, if we have more of an uncertain environment and volatile, and even if rates tick up, equities are going to take it a heck of a lot more on the chin than bonds. But the other thing that we're seeing now is...
Write that down.
Yeah, the other thing...
I'll think about that later.
On the chin. The other thing that we have to be mindful of is as the Fed has intimated that they are going to scale back, tighten policy, and raise rates, we've actually seen a decent flattening in the yield curve, meaning that at least how things stand right now, bond investors don't think rates are going to rise in the near term. And if the Fed stays on this path of we're going to tighten, we're going to tighten, we're going to tighten, then they're pushing on the brakes. And historically, that's actually led, at least in the short term, to falling longer term rates, which would be helpful for those type of bonds in that environment. So again, it's more around this uncertain environment. The biggest material or marginal impact here would be moving money from equities to bonds, not necessarily where it goes within fixed income.
Equities will be more impacted by increases in interest rates and bonds.
No, I'm sorry. Just if we get into a more volatile equity environment, And we see.
Bonds will be more stable.
Exactly. So that's the material impact, is moving equities to bonds, not necessarily where the money goes within bonds.
So the key word is volatile environment. Okay. I don't know why I'm writing this down, but I'm going to write it down.
So as I mentioned.
Oh, sorry.
I'm sorry, Dr. Bridget. Go.
I was just going to ask if there were any other questions or comments from the board regarding the rebalancing suggestion. And Pat, I didn't mean to interrupt you. Did you have anything to add, or should I go ahead and entertain a motion?
Oh, please do. I was just going to outline what's on page 5, but that'd be right in the motion. So
Okay,
go ahead.
great. You can outline what's on 5, and then I'll ask for the motion.
All right, great. So
Thank you.
as summarized on the previous page, you can see in that table the explicit recommendation of adding $80,000 to the iShares Core U.S. Aggregate Bond ETF, and the sourcing of those funds would come split evenly, again, from $40,000 from the Vanguard S&P Mid-Cap 400 ETF, and again, from the existing cash
Like your
allocation.
motion.
It does sound like the motion.
Or it sounds like a motion,
Is
yeah.
is the board ready to make a motion on the proposed rebalancing?
So moved.
We have a motion on the floor for the proposed rebalance found on page 5. Is there a second?
Second. In discussion, I would say the motion should read, we move that we take 40,000 from Vanguard, mid-cap, and 40,000 from cash, and add the 80,000 to iShares Core's U.S. Aggregate Bond ETF. You
Yes,
take that as a friendly amendment?
absolutely.
Great, thank you for the clarification. We have a motion and a second. Is there any further discussion? Hearing none, all in favor?
Aye.
Any opposed? Motion carries. Thank you. And next is our investment policy review.
All right, thank you, Dr. Bridget. So you will find this behind the next tab, and there are 2 handouts here. So based on our discussion in the August meeting, I believe there was a request at that time just about the draft of the new IPS, whether or not we could just redline the existing one, and given the material changes that we were proposing, the request was just briefly come back and talk about the changes in the existing IPS and how that would be materially different from the current. So what I'd like to do, just quickly, is walk through the current one, where you see the highlighted asset strategy consultants on the bottom, and just again highlight the material differences before we get into the existing document, and we can do this first one in rather short order. But you see on that cover page and throughout this document, the material changes will be highlighted. So at the bottom right there, you see again the previous advisor. So we're of the belief this is a county document. So, regardless of who the advisor is, it's a county document, it's a board document, that you shouldn't have to, say, amend the policy based on changes in vendor usage or anything not related to policy itself, right? So that's really the key takeaway on that page, and then a similar story on page 1 as you flip over, again, with the executive summary highlighted at the top, and then we've highlighted current assets at, I'm assuming that should be 2 million, but it says 2, and the expected return is 6%. Again, these are things that are dynamic, right? They're kind of, the current state of play and things that aren't necessarily policy. So again, you don't really want to have to amend the document based on the changing nature and changing characteristics of the fund. And it's a similar story on page 3 here. Again, the next highlighted pieces of this document, the
Pat,
background.
Can I just jump in?
Oh, I apologize.
No. So the items that are highlighted are you're proposing to delete.
Essentially, what I'm proposing or highlighting is the material differences of what's in here now versus what's in the document that we drafted. So you won't find, our name, you won't find the size of the fund or the explicit return, because those things that change, and you don't really want to have to amend something
Change the
that
policy.
could change and really isn't policy. And that's pretty much on page 3 as well, where you see the background and listing of all the vendors. So again, those things aren't policy. They're just, what's occurring right now. So we're of the mind that, again, you shouldn't have to amend policy if you change vendors, because it has nothing to do with the investment policy of the fund itself.
When we due to see Mr. Binder again?
February?
Yes.
Okay, a couple months.
the next meeting, because we don't have a meeting in January. So
Right.
he'd be on the
And-
February meeting,
Okay, then I'm.
every other month.
All right, then Binder's coming in February?
Yes, we've invited him.
God, I mean, look, we'll wait till we get there, but I'm not gonna be out of town that day. So it would be wonderful if we could change that day a couple days. It's not about me, but, I love that guy.
We can certainly
Hate to
look
miss
at
an
the
opportunity to
yeah,
talk to
meeting
him.
schedule.
We can
Yeah.
change it,
We can
sure.
look at that
All right,
meeting
we'll look at that
schedule.
when we get
Yeah, that's fine.
There's so many jokes running through my head. Namely, does Commissioner Hewitt say the same thing about me when I'm not here? I don't know.
I just
I
like
love
to be
that.
here when certain
I
people
love
are
that
here.
guy.
About me and my vacation schedule. It's about, I get paid to be here, so.
That's right. So just a couple other quick things to highlight, or that are highlighted, that I wanted to mention. So on page 4, again, the key themes are, things that aren't policy, that are dynamic, that can change. We don't want to have to amend something for that. So at the bottom of page 4, you can see the note that short-term liquidity requirements are anticipated to be non-existent. Obviously, that's been the case historically. I can't necessarily speak to it, but I imagine that to be the case, at least in the near term moving forward. But things change, circumstances change, and again, we don't want to have to amend the policy just based on, that statement alone.
But I read this too. Tell me, what would you, give me an example of what would be a short-term liquidity requirement? That would need to be,
It would be I assume this is PAYGO now, out of the general fund for the benefit payments?
Right.
Right, so that would be, liquidity requirements as it relates to the fund. So if you stop doing PAYGO and start drawing from the
I
fund.
got you.
Yeah.
That needs to be thought about, right?
Right, exactly. So again, that may not change in the near term, but if it does, we don't want to have to amend the document to reflect that, because again, it's not necessarily policy. On the next page, on page 5, what I've highlighted here under performance expectations, and we have those, and I'll highlight them in the document, but as you can see, the 3 highlighted sentences, there are 3 different numbers here, right? 6.3, then the actuarial assume of 6, and then market performance is 7.5. So at the end of the day, what are we trying to do? Trying to meet that actuarial assumed rate of return. That's the most important bogey. That's the most important benchmark. So in the new document, that is explicitly stated, but we don't state the explicit number because it can change, right? And we don't want to have to amend the document if the board determines, a higher or lower number is more appropriate. So again, we have the actuarial rate as a good target for returns, but we don't explicitly state it again. On page 6, and this is really important, and I'll have another quick example of this in a second. So when you see asset allocation up top, and I've highlighted 3 asset classes. So anytime you have asset allocation, you're saying, hey, this is a permissible guideline or permissible investment for the fund. We need guidelines around that. And right now, for 3 of those that are highlighted below, the current document does not have guidelines around it. So again, anytime you're saying we can do X, Y, Z, you want to have guidelines to say, how we're going to do it, why, and what's permissible within it, and any other constraints. So the new document will clearly delineate those for all the asset classes that have previously been approved for a long-term allocation. The next key takeaway, I think it's a little further on here in page 8, and this is what I wanted to highlight around my comment from just a second ago.
Pat, if I could just.
Oh, yes, I apologize. Go ahead.
No, I think you have something on 7.
Oh, I'm sorry.
Yeah, under domestic equities.
Oh, yes, I apologize. So yes, under domestic equities, one of the things we highlighted here, the current guideline was not to hold more than 5% in any one company, so any individual manager couldn't hold more than 5%. We had originally proposed that to be 10 because in certain markets, namely like large cap U.S. growth, which is dominated by the Apples, the Microsofts, and those names, they comprise 10% of the benchmark. So if you have that constraint, you're sort of structurally tying the hands of an investment manager and not being able to make an active decision. They would have to be perpetually underweight that from a benchmark perspective. And actually, when we get to the OPEB report later on, you'll see the impact of that based on what happened in that segment of the market. So in the original document, that was a proposed change, and I'll provide more color around that when we get into the new document here in just a minute. So on page 8 now, when you see under domestic fixed income, this really circles back to my comment around there being no guidelines for high yield within the document. So high yield is below investment grade bonds. And here under domestic fixed income, you say, every bond has to have a quality rating no less than BBB, which is the lowest rung of investment grade. So technically, we can argue it's semantics, or we can argue that technically we're kind of in breach of the policy here because we have the allocation of high yield bonds, and there's no permissible language around that asset class. So that's something that we square in the new document. And then the other one on this page, the international equities, is the same comment I made a second ago around domestic, around the 5% versus the 10% in any individual security. And I think it's two or three other quick things here. The next few pages just talk about selection of money managers, duties, responsibilities, things of that nature. Those all are all in spirit in the new document, so there's nothing material to highlight there. So it's on page 14 where you see the next sort of huge highlight in this table, and what this is saying is...
Hey, what, you wore your pen on, huh?
In this page, you can see what this is saying is that not just for the asset classes themselves, but for the managers within them. If you look at large cap equity, value growth core, you're defining the benchmarks and the universes. So when you think about policy is really around asset allocation from a benchmarking perspective. When you get to the managers themselves, that's more implementation. So if you say any manager we use in these respective buckets, this has to be their benchmark, even though it may not be the appropriate benchmark for that strategy. So again, this is not really policy, this is more implementation. And if we were to use this, it would really constrain the managers available for inclusion because they would more or less have to use these respective benchmarks, which may or may not be appropriate. So again, something we think is implementation, not necessarily policy. And I believe the last item is page 17 here. So again, just quickly, again, this being a county document, when we have the signatures pages in the new document, it will be for the trustees themselves. Dr. Bridget was the lone signatory on this document. We're of the mind that really all trustees have a vote on the policy itself. So in the new document, we list all of the trustees for the respective signatures. So that's the other key change that I wanted to point out. Questions, comments on anything that I talked about on the current policy before we move into the new proposed document?
I'm just concerned about the time. We're at 10:30, which is when the OPEB meeting starts. So are folks comfortable to have the review, or do you want to do that next time, or read it in between and ask for questions?
We can read it in between and come back.
Yeah, I'm fine with that. I mean,
If I could just make one quick comment on it, I don't even have to open it. But so, as many of you know, we did this lengthy discussion for the SORP IPS. So you'll see a red line version in here, which largely reflects the approved changes from the SORP board to the IPS. So when you work through here and you see some of those changes, just for context, I thought they were all reasonable, they were all approved. So just have that in the back of your mind when you're reading through this document. They're not coming from me. They're coming from, a board many of you already sit on that were approved, which I think are very reasonable, are now proposed changes for the LoSAP.
I'm sorry, what board is that?
The SORP.
Oh, SORP, okay.
Yeah.
So they've already adopted?
Yes.
Okay, gotcha.
Yes.
Great. And then the expectation, Pat, is that we would come to a vote next time to approve the IPS, or at a future meeting?
Yeah, so what I
Folks are
can do is I'll bring copies of this again. I can bring a clean copy, assuming everybody's on board. If everybody's not on board, then I'll make the appropriate changes and we'll circle back to that.
So, Madam Chair, I'd say what you probably want us to do is make any changes, get it back to you, so you can get it to him, or however we do that.
Get it back to me and Jody.
Okay,
And we
yeah,
will
whatever the
actually-
appropriate.
Thank you.
Yeah, that would be great. Thank you. Great, thank you.
You're welcome.
And then, do you want to go over next steps for us?
Yes, and this will be very, very quick to wrap up here. So at our next meeting, which will be in, well, I guess we'll see.
Right.
We'll see when that is. We'll have the Q4 investment performance report like we had today for Q3. We already know what we'll have with the investment policy, the recommendations, and then just quickly on the custody RFP update. That's been moving along, and Ms. Pratson, please correct me where I stray off course here. The submissions have come in. The Technical Evaluation Committee has been distributed those submissions, so we're in the process of scoring them, which is due in about 2 weeks' time, maybe between 2 and 3 weeks. So once that's taken place, we will work with staff to get that in order. We expect to have 1 or 2 firms come in for the presentation to ultimately select the winner of that award, which we expect to happen in Q1, and then that transition to take place in Q2. So we're moving along nicely in that process.
Great, thank you. Any questions or comments on any of those items, the custody RFP update? Any of them? Okay, great, thank you. And then we're going to look at subsequent meetings. And so, Jody, when's our meeting in February?
So right now, Dr. Bridget, we have it proposed for February 25th.
And I would say, sorry to, guess I could zoom in, but I'm not going to zoom in. Either the 11th of February or the 4th of March would work. But look, it ain't about me, it's about,
Either one of those dates works for me. How about other folks? Do you have your calendar? Is that
Fine with
okay?
me.
Yeah, we're fine. So you said what, March?
March?
either March 4th or February.
Does that give you more time, March 4th or February 11th, in terms of finishing out the paperwork to bring to the meeting?
March 4th, I'm actually in Disney World.
So February 11th.
I'll talk to you about that after, I just got back from that place.
Did you? February, what is that?
February 11th is 2 weeks earlier.
So that's a Friday. That's a
A Friday.
Oh, yeah, Fridays are.
February 11th, is that okay for the board members?
Fine with me.
Yeah, find out what binder too.
And may I have a motion on the floor to please adjust that so that we can, I know Michelle will have to report that for the boards, committees, and commissions.
Right. I'll make a motion to change the meeting from February 25th to February 11th for the next meeting of LoSAP.
Thank you. Is there a second?
I'll second.
Any discussion?
I just had a quick question. Do we need to approve the entire calendar for next year?
Probably.
Yes, we do.
Yeah, so could we amend the motion and approve the calendar for 2022, the meeting dates, with the change from February 25th to the 11th?
Yes.
Sorry, and I was looking for them on board docs. Are they listed somewhere? Am I ahead of myself?
They're on the plan administrator report.
Oh, thank you. That's why I was looking for the calendar instead of the plan administrator. That'll do it. Okay, great. Thank you. Then would you like to withdraw the motion? And then we'll capture it all in the plan amendment.
Withdraw.
Well,
No?
gosh, I hate to tell you guys, but I'm probably going to miss several of those. Look, we're on, my wife and I are like taking some serious vacations.
Nice.
We're going to be
That's
gone.
nice.
That is nice.
Yeah, we're gone the first week in December, we're gone the middle of October, we're gone the end of August. Jeez, sorry. Maybe I should just give this seat to somebody else.
So since we're meeting every other month now, these are just I think the last Friday, right, of the month, every other month. Is that how we built the calendar?
But here's what I guess I would ask Ms. Pratson. Would you be okay with doing the 25th to the 11th of February now? And as far as the rest of the schedule, it's not about me. I'm sorry to be a pain in the ass. I'm sorry, and don't put that on tape.
It's on tape. Committee,
Sorry to be a-
that's okay. So let's pull back just a second. Let's get organized just a minute. So for Pat's discussion, I think we're wrapped up there. So we'll go to committee reports
Yeah, okay,
and
okay.
shift over to the plan administrator's report, and we'll see if
We
we
have
can
a motion and
cover
a
it.
second on February. Is it
But let-
still
yes.
there?
So I thought we
With the
withdrew
motion.
that motion.
Yeah.
Oh, okay, sorry.
Okay, so is that according to, am I okay, Michelle, that you have that on the kind of chronology of events? We withdrew the motion, and now we're going to look at the plan administrator's report. Then we can change any dates and do an amended plan administrator's report.
Got it.
Cover- Is that fair enough?
Yes.
Okay, so Jody, you want to kick us off?
Sure.
With the easy part first?
Thank you, Dr. Bridget. So since the last meeting, the trust has dispersed 3 transactions, $2,500 to Bolton Partners for the benefits study, $1,420.05 to Marquette Associates for investment consulting, and then $3,592 to Riggs, Councilman Michaels, and Downs for the annual fiduciary insurance payment. So now we move to the proposed dates for 2022, and these proposed dates were prepared based on the board's request for the 6 as opposed to the 4 last year. They do coincide with the OPEB meeting dates, which are on the same day, and then they fall the day after the SORT meeting dates, and those were the items in consideration for preparing the calendar.
And so will the OPEB meeting calendar be reviewed in our next meeting as well?
Yes, it will, Dr. Bridget.
Okay, so let's keep that in mind. So let's just go down the dates. February 25th, we're looking at amending to the 11th.
Right.
And that was okay with the other board members. How about April 29th?
Good,
It's fine.
Is that what's okay? All right. June 24th?
good.
August 26th?
Hold on.
That one is not good, right?
That is what now?
You said
Not
that-
good?
You said that that was not.
Yeah, again, that's not good.
That's okay.
Yeah,
Well,
we-
that's
We can make whatever changes.
right. And so if the 26th, do you have another proposed date, either the week
The-
after?
The 19th or the 9th?
I think
19th is Mako.
right. So I think the 9th is a better date
The
for
12th
us.
is
for
a
sure.
September?
No, the 12th.
Oh
or
no, the
20th, yeah, the
Oh,
12th.
well, yeah.
the 5th,
The 5th
the
or the
5th or
12th?
the 12th.
We're getting the 5th.
Wait a minute, are you back, are you in?
We're in
I'm in
August.
I'm in August.
I'm in
22.
August.
Of 22?
Yes. So August 12th.
Oh, the 5th, I got you.
So if you go
So
back.
if you do June 24th, the 5th gives us like 6 weeks. That seems,
Right, that's kind of like now, where we are now.
okay, I'm with you. Now, is the 12th a bad date? Is that Mako?
No, Mako.
Yes, I would say that would not be a good day.
The 12th is okay.
The 12th and the 19th, the commissioners are out of session.
They are.
And so if Commissioner Hewitt or any of the directors take leave, that's usually that week or the week
What about
after.
September 2nd?
Look, I got it. Yes, September 2nd. I know. I'm back.
September 2nd?
It's the Friday before Labor Day weekend.
Oh, yeah.
Not that I have plans, but.
We've done that before, though.
We have done that
We have
before.
done
Okay.
before.
Yeah,
Okay.
we've done that
Look,
before.
I hate to be about me, I'm sorry.
All right,
Can we
September 2.
Can we just do the 11th for now? And but
The
we're
11th.
doing like
The 11th.
Canada,
So-
Croatia,
So
and
how the-
Germany. So these are things where I can't really,
So it's not a problem.
Okay.
How we do it is the boards, commissions, and committee post our annual meetings by January 1. So that's why we're trying to get all of them out in December. We submit them to Diane.
okay, tell me this, can we do these things by email amongst the group? Or do we have to do it in open session like this?
No, I think we have to vote on a schedule at some point. So even if we try and coordinate schedules, we'd have to bring it back to the meeting for an approval. And so even if August 26th is a challenge, let's look at October and December for those 2 dates.
Okay.
Are we okay with that one?
I think Commissioner Hewitt said he was not good with either.
For October or December?
Right.
Okay.
But again, it might be, I just think that's when we're out of town. Because our anniversary is the 15th.
Can we approve these dates and then amend them?
Yes. So that was going to be my next suggestion.
All right, let's just do that.
Let's change the February to the 11th, leave them, and then as we need to change them, if we need to change them,
Plan by.
then we will do that accordingly. Okay? That
good.
sounds good. Is that okay? Thank you for walking us through that. I think that was important.
Sorry to make that such a pain.
No, that was okay. That's
In the
the
neck,
purpose
pain in
of
the
it.
neck.
purpose of it.
We track my work.
And so with that review, thank you for the discussion. We'll take a motion to accept the plan administrator's report as amended.
I'll make a motion to accept the plan administrator's report as amended.
Thank you. So there's a motion and a second. Any further discussion? Hearing none, all those in favor?
Aye.
Any opposed? Motion carries. Thank you. And then we have one old business item. Catherine?
Thank you, Dr. Bridget. This is in follow-up to the volunteers' request for increased benefits. And you may recall, we've spoken about this a number of times, and we spoke about this at our August meeting. And one of the takeaways from the August meeting was to do some inquiry to see if we could find an estimate for an audit of the points lists that are provided to the commissioners for approval every winter. So thank you to Jeanette. We reached out to the auditors at S&B Company that are currently under contract for the county. They have done this kind of work for other counties. What they have proposed, and I believe this is included in your literature, is a test, and please correct me, Jeanette, for the appropriate words.
Upon procedures.
And they would test that the companies, the volunteer companies, are following procedures and policies to create the lists that the commissioners then approve.
Right. And if you look at the document, it's probably the last 2 pages in your package, dated November 22nd at the top. You can see the procedures are in the middle of that page.
Right.
Do you see that, Marion?
No, I'm looking.
It's probably the last 2 pages. Where it says, it has no letterhead or anything, it just,
Oh, right,
Addressed
right,
to
right,
me,
yeah.
yep.
I see it.
Yep.
the actual procedures that they have discussed in reviewing and testing are in the middle, where it says we will apply the following procedures.
Right. I read this last night. Yeah.
And then what would happen is if a company, for example, did not have procedures and did not follow the test, then someone would make a decision as to do we need anything else? Does anything further need to occur? But their initial take on this would be they would assess whether, appropriate policies were being followed to create those lists.
Right.
Did I read this to mean that they also would recommend that they have a policy in place? If they don't have one, that they get one?
And they're supposed to have one.
Yeah, that's what I'm saying.
So they would look at our current legislation, which is in the county code, what is required, and seeing if that is actually what is occurring.
Got it.
Right.
And I jumped in, I should have explained that the volunteers, they originally submitted multiple requests for benefits, and they modified their request and submitted a letter to the commissioners in October. And on the email or the memo that I've included, the modified request is only the benefit increase now. So you may recall they originally talked about health insurance, they talked about gift cards, they talked about access to the landfill, and that's all been stripped away, and what remains is this requested benefit increase.
And so I know that you have it on for a presentation today. What's the expectation, Catherine, of the board?
I guess discussion, and I don't know, and I'm really open to everyone's opinion, if we felt that it was a good idea to have some kind of an audit, does that go before the commissioners for approval before that occurs? The timeline is that the volunteers will submit lists by February 15th to the commissioners. There is no timeline for the commissioners to approve the list. If we were to engage S&B, they wouldn't even be able to begin their work until after the submission of those lists.
And I would assume we would, so where's the proposed funding for the $17,500? That be from the commissioners
It
or
would
from
come
the
from the
trust?
trust.
Or from the trust, I would think.
So as we've, like with other boards, as we've had extra studies done, either work done by Bolton or other work that's been done or reviewed by Mary Claire.
Right.
This is the same kind of a thing. The board has made decisions and approved whether or not to go forward with this and to have the trust make this payment. Because there would be another expense that would come back.
Right.
So that's what I was trying, so it's the authority of the board to have this approved, action taken, and then report to the commissioners with the outcome, as we do
Report
with
back to
others.
this board and then probably to the commissioners.
Yes.
Yeah.
Okay. And then potentially an advance memo to the commissioners,
Right.
because it would certainly change the process that everybody's used to. Because typically, HR is bringing forward in March certified lists, saying, commissioners, please approve these. And that wouldn't occur if we were to go this route, because S&B would do their work first.
I think the primary reason we're doing this is because with COVID, and I love blaming COVID for some things, I hate blaming it for others, we had this emailing idea as the way to be qualified that you went to a meeting, or, because they weren't really doing Zoom.
Right.
But I know if you got an email and you responded to the email, and I'm not sure that was should have been credited towards points, but I don't want to break down, because these people are thank God we have them.
Right,
Last thing we want to do is alienate anybody or indicate that there's an issue.
right.
But I think the primary reason is COVID kind of changed it from what it used to be pre-COVID to what it is during COVID. But hopefully it's getting back to normal. I know my wife's going to all her meetings in person now. And,
I think it was that, and I think it was the dollar amount of the requested increase in benefits.
true, too.
And the feeling was, if we were to consider, or if the commissioners were to consider that, there had to be some kind of support behind it.
Catherine, when are the points due to, we have to submit them to the state, the comptroller's office, don't we? On all the qualified?
Not that I'm aware of. I read the code, and they have to submit them to the commissioners by the 15th. The commissioners have to certify them. They have to be posted in the companies, because people in the companies have 30 days to say, I agree or don't agree, or I should be on that list. So there's that process, and then they're finalized.
Okay. For some reason, I thought that we submitted them to the state for them to receive the tax credit. Maybe I'm
They
thinking
have
of
a letter
something.
that they have to submit with their return. I don't
Okay.
know.
Yeah.
Okay, you familiar with that?
Maybe that's
Yeah,
where.
okay.
Tell me,
Yeah.
and I'm sorry to interrupt, aren't there, I know we're talking about 150, whatever we're talking about here, 400, 300. Isn't it also a credit for tax benefits for the state of Maryland?
Yes.
Would it be property tax or income tax or something like that?
It's income tax.
Income
That's what I'm
tax.
talking about.
That's what we're
You put
talking
the letter
about.
with the income tax and you get a credit on your.
Now, does that usually take 30, 20, all these years of service?
Whatever benefit they're getting, if they have enough points, they get the letter.
I guess my point is, I'm under the impression they receive a monthly check,
Oh, yeah, they do.
okay? But they also receive a benefit on their Maryland state income tax
Correct.
that they have to pay.
Correct.
So
It's
there's
a-
two benefits there.
Right.
Right.
But both of them are predicated on the length of service, i.e. the 20, 30.
And the points,
Yes,
the
Well, yeah,
accumulation.
definitely the points. But
yes.
the years of service have to be, if you're under 46, you have to have been in there since you were 16.
Yeah. So does the letter, Mary Ann, come from the department? The
Yes.
rescue squad or the fire department? They're the ones that provide that letter?
Ah,
Okay.
that's
correct.
Okay.
All right.
Okay, that's the clarification I needed.
Well, but your point is well taken, because if that is due when people are filing their income taxes, that's April.
Right.
So that
Kinda wide.
impacts timeline.
Certified.
Right.
Well, I wouldn't say April. I mean, there's a lot of people that get that rascal right in.
Yeah, right.
Because
exactly
everyone wants their
right.
refund,
Right.
Right. And so I think it sounds like if we want to approve it, and folks are comfortable, that we do a motion to approve it moving forward, and then in February, get an update as to where we are in the timelines and the status, and then the recommendations moving forward.
Or can we approve it in February? Or would it be too late?
I think that would be too late. I mean, for this year, I guess if we did an audit and approved it in February, then it
You're
wouldn't
right, you're right,
impact
you're
till
right.
next
No,
year.
you're right.
What are we approving?
Conducting the audit. If we
Just
want to
conducting the
allocate,
Yeah, get SB guys
Just
to
get,
take
just
a look at
conducting
what's.
the audit.
just conducting the audit and allocating the funds up to, I think it's
17 is the
17.2
high.
or something.
Yeah, 17.5.
Right, and so we'd have to allocate the funds from within the trust.
So would there be a possibility that after the audit was done, let's say everything's fine, that the Board of Commissioners would say, no, we're not doing this?
Oh, yes, yes, it's a $1.9 million.
Right, that's why I'm
I
wondering.
agree, it is a big hit.
So
Right.
should we see if they're even going to approve that before we go?
My
into-
sense is, look, we got to take care of these guys. I'm only one guy, I'm only one commissioner.
Right,
But I got to believe there's a sensitivity that they
okay.
don't want to like not do their benefits, goodness gracious. Even though it's a lot of money, but it's,
And so I think it's a matter of when for an audit, right? Because if it's not this year, it's going to be the next year, I mean, it's going to happen eventually.
I think
and
they'll-
they'll-
soon-
To have it anyway.
It's going to happen anyway, is my point. And so even if we do an audit and then there's a time frame that there's a recommendation for when the next one occurs, but, you know, the recommendation's been on the table.
Has.
And as long as the fund has been increasing, it's now in excess of $9 million. You know, I think there was a recommendation a couple of years ago from the auditor that said when this fund is now getting substantial dollars, you know, there needs to be the backup for the support of the policy is being, you know, followed.
And I think that speaks to, without any improvement in benefit.
Right.
The last annual report, our audit report, it was a $20 million benefit to
Right.
the volunteers. And that's from 2 years ago.
Right.
yeah, right. When it was
So-
real low, it didn't seem to make any difference.
Right, and so this is,
Ow.
right, as it's
Again,
unfolding.
it's getting up there.
Right, so I think it's just a matter of when, whether the benefits are changed or not.
Well, I think the audit needs to be done. So I'm
Yeah,
going to make a
okay.
motion
Okay.
that
I
we
agree.
approve the audit.
Okay,
Okay.
Approve moving forward with the audit.
okay.
That's a motion.
There's a
I'll
motion on the floor and a second, thank you. Is there any further discussion? All in favor?
Aye.
Aye.
Any opposed? Motion carries.
So then I will bring forward an update in February, at the February
Great,
meeting.
thank you.
Okay.
Great, thank you. And anything else today on, from the committee members? Hearing none, we'll have a motion to adjourn.
Motion to adjourn?
Is there a second?
Second.
All those in favor?
Aye.
Any opposed? Motion carries. Thank you.